Welcome to this explainer. Today we're diving straight into a massive paradigm shift. We're going to explore exactly why a high income, no matter how big that paycheck actually gets, will never on its own equal true wealth. If you've ever felt like you're making pretty good money but somehow you just aren't getting ahead, you are definitely not alone. Over the next few minutes, we're going to completely dismantle the active earner mindset and show you the exact mechanics of how to build a real, fully automated money machine. So here is our roadmap for today. We'll kick things off with the income trap. Then we'll contrast earners versus owners. Next, we'll dive right into the 5 wealth-building assets and wrap up by showing you how to go about building your money machine. Let's start with a really provocative question. If a salary makes you rich, why are so many high-earning professionals broke? Seriously, corporate earners bring in tens of thousands every month, yet a shocking number of them are literally one missed paycheck away from total panic. They're highly comfortable, sure, but they're absolutely not wealthy. A salary is fundamentally designed to keep you just comfortable enough to keep showing up, not to actually give you freedom. To understand exactly why that is, let's jump into Section 1, the income trap. Think about this single number, 24. A salary has a hard, mathematical limit because you're trading the most finite resource in the universe, your time, for money. You only have 24 hours in a day. It genuinely doesn't matter how dedicated you are, how much you hustle, or actually, even if you manage to bill $1,000 an hour. Eventually, the clock always runs out. Hard work simply cannot scale your time. Your active income has a hidden ceiling, restricting your financial potential entirely because, your physical presence is required for every single dollar you make. And right alongside that mathematical limit is the psychological trap that keeps us totally stuck. It's the cycle of earning more income versus expanding your liabilities. You know how it goes. You finally get that big promotion, and suddenly your perfectly fine old car just isn't good enough anymore. Or you suddenly need that larger home with the massive mortgage. You think you're winning because your cash flow went up, but your net worth? It's exactly the same because your new liabilities just ate the difference. This is the dreaded lifestyle inflation. Earning more automatically triggers spending more, which basically keeps you trapped running on a treadmill, burning endless energy but staying in the exact same spot. Which naturally brings us to Section 2, earners versus owners. So average earners trade their hours for cash, right? But wealthy individuals act more like architects. They own earning assets. The wealthy never trade their time if they can help it. Instead, they focus entirely on building and acquiring automated systems that execute without their physical presence. It's kind of like the difference between pushing a heavy boulder up a hill all by yourself versus building a mechanical engine to do the heavy lifting for you. If you want to build wealth, you absolutely have to stop focusing on active income and move entirely from physical effort over to leverage. The fundamental mental switch here is shifting from consumer to owner. Consumers eagerly trade their capital for depreciating status symbols, flashy clothes, luxury cars, things that literally lose value the second the receipt is printed. Owners, however, treat their cash as literal employees. They trade their capital for assets, sending those dollar bills out into the economy to recruit more cash. The truly wealthy prioritize these assets first, and they only buy their luxury toys much, much later, using the passive profits those assets eventually generate. And that perfectly sets up our core solution in Section 3, the 5 wealth-building assets. Here is your mental checklist of the leverage vehicles we are going to cover: stock market equity, rental real estate, scalable business ownership, intellectual property, and cash flow paper assets. Let's get right into the mechanics of why these work so incredibly well. First up is stock market equity. And look, forget Wall Street day traders staring nervously at 6 computer monitors. That's just a highly stressful active job. True ownership means buying index funds. By owning a low-cost fund tracking the S&P 500, for example, you essentially have the CEOs and employees of the top 500 companies in the world working tirelessly to increase your net worth while you're literally sitting on your couch. They're innovating, they're selling, expanding, and you own a slice of that collective human effort. It requires zero daily input from you, zero guesswork, but offers infinite scalability. Second is rental real estate. This completely flips the script on how society generally views debt. Using a credit card to buy a massive TV? That's toxic debt. But taking out a mortgage to buy a duplex or a fourplex? That is leverage. You are safely using a bank's money to acquire a highly valuable physical asset. And the beauty here is that you win in 3 different directions simultaneously. A tenant pays down that bank debt for you, they provide you with consistent monthly cash flow to put right in your pocket, and the physical property appreciates over time due to inflation. It's a massive win-win-win. Third is scalable business ownership. Notice the vital keyword here, independently. If your business falls apart the minute you go on vacation, you don't actually own a business, you just own a highly demanding job. A true scalable business is a software platform, a franchise model, or maybe a fully staffed agency where standard operating procedures run the day-to-day. You step back into the role of an owner, totally decoupling your personal income from the hours you physically work. Fourth on our list is intellectual property. This is basically the ultimate modern asset class. We're talking about software code, content libraries, a written book, or digital licensing. The pure magic here is the concept of zero marginal cost of reproduction. You put the intensive hard labor in once to engineer the asset, but the cost to duplicate and deliver that asset to the 2nd, the 100th, or the millionth customer, it's exactly zero. It's a highly scalable extra income stream that just runs 24/7 on autopilot. Finally, we have cash flow paper assets. A classic example here is dividend-paying equities. Instead of just banking on the stock price going up to make money, these established companies legally share a portion of their quarterly profits directly with you in cash. But the real wealth hack here is the automated reinvestment loop, often called a DRIP. By automatically using those cash dividends to buy more fractional shares of the company, well, those new shares then pay you even more dividends. You create this compounding snowball of income that grows exponentially until it eventually replaces your active salary entirely. All right, let's move to our final section, building your money machine. So we've covered the theory and the leverage behind these assets, but how do you actually start executing the shift today? Well, building wealth isn't about raw intelligence. It's entirely about system design. Step 1, secure your baseline cash. Plug your hidden lifestyle leaks and build an emergency buffer so something like a flat tire doesn't force you into toxic debt. Step 2 is absolutely critical. Automate. Human willpower is deeply unreliable when faced with a shiny new purchase or a stressful day. By routing your investments automatically the exact moment your paycheck clears, before you ever even see the money, you remove human error from the equation completely. And step 3, step back and let it compound. Now, you really got to understand the decade trick. In year 1, building wealth feels agonizingly slow. The compounding is nearly invisible, which, by the way, is exactly the point where most active earners give up and go right back to consuming. But by year 5, you finally build some momentum. And if you hold on until year 10 or 20, the math goes completely vertical. The wealthy plan decades ahead because a long-term perspective naturally deletes the daily noise. Starting early with small, automated amounts will absolutely crush starting late with massive amounts. So the absolute crucial point to take away from all this is boring consistency will always outperform spectacular intensity. Getting rich quick is a complete consumer trap. Short-term bursts of intense saving or risky crypto speculation usually just end in total exhaustion or total loss. True wealth is built on boring, predictable daily execution. Say no to current desires, let your capital multiply, and realize that delayed gratification isn't a punishment. It's the absolute mathematical guarantee of your future financial freedom. I want to leave you with this final provocative thought. Every spending decision you make is a trade. You aren't just trading $50 for a dinner. You are trading the future opportunity cost of what that $50 could have become if invested and leveraged over 3 decades. So look at your upcoming spending decisions this week and ask yourself honestly, are you buying status today or are you buying freedom tomorrow? Adopt that owner mindset, give every single dollar a job, and start building your automated money machine today.